guys, today we're talking about index funds. So what are index funds? An index fund is a type of mutual fund with a portfolio constructed to match or track the components of a financial market index, such as the S&P 500. An index mutual fund is said to provide broad market exposure, low operating expenses, and low turnover expenses. So should you invest in index funds? Index funds are passively investing in the market. You wouldn't have to do much, but you'd get great gains. So savings accounts produce around 2%, and these are great savings accounts. S&P 500 produces about 10%, 7% adjusted for inflation, and inflation is about 2 to 3%, which matches the savings accounts. So if you invest $1,000 and you add $250 every month, after 30 years, you'd end up with $446,000. And if you do the same thing, and you invest $250 for 40 years, you'd end up with $1.32 million, which is... So actively managed funds versus index funds. Most actively managed funds underperform the stock market with a few exceptions, and actively managed funds have a lot more fees involved, which will affect your return negatively. So what are these fees? These fees are called expense ratio. So what are the components of an expense ratio? The expense ratio includes numerous charges for smoothly running the mutual fund scheme. They recover this cost from the mutual fund investors on a day-to-day basis. However, they disclose it to the investors once in every 6 months. So here are some of the better index funds. Usually they all perform the same. It's just a matter of their expense ratio. So for the Vanguard 500 index fund, it's 0.14%. and it has generated 14.26% return. Obviously, this isn't updated, because if it was updated, the returns would have been a lot more, especially considering 2019 and where it produced 30% or more. And the Schwab S&P 500 index fund, which has an expense ratio of 0.02%, which is extremely low, meaning if you invest $1, it's less than 2 cents, basically. It's basically 2 cents. So the Fidelity 500 index fund, which has an expense ratio of 0.015, which means if you invest $1, you would have to give 1.5 cents every year. Then there's T. Rowe Price Equity, and yeah, that's about it. So how is the money distributed? So money gets distributed to each company based on its market cap divided by the market cap of all 500 companies. I'm saying 500 because the S&P 500 has 500, but different mutual funds have different amount of companies. So when you divide and convert it, you get a percentage, and what is the percent? And that is the percentage of money that goes to the company. Example: 500 companies are worth $2 billion combined. Company A is worth $1 billion. So whatever is invested, 50% of it goes to company A. For example, you have $100, and $50 of the $100 goes to company A. Obviously, one company won't have 50% of it. This is just an example. But thank you. Leave a like and subscribe. Comment down below what videos you like.